Today is Monday, August 5th, 2024. I'm going to put my foot in my mouth most likely because it's impossible to predict the markets. But right now, everything's on fire. If you're heavily invested in tech stocks, you probably got a 10 to 15% haircut. If you're all in on Nvidia, you probably got a bigger haircut than that. And I think a lot of that we have the whole issue going on with the secondary market in Japan with borrowing, is it the yen? Because they have like 1.5 interest rates right now, and people would just borrow 1.5% loans over there and come invest in US markets. 5%, you make a 4.5% difference profit. And why wouldn't you do that? It's basically free money. But what happens is when markets go down, you start to get margin called, which means you have to throw up the capital. And if your asset that you bought with it is worth less than what you paid for it, guess what? You're kind of SOL and you're at a loss. You don't have the money. You have to sell off other stuff, personal assets, cars, whatever. We got that going on. We had the hot swap happen between Biden and Kamala, not to get political here. But after the first debate, the markets had kind of priced in a Trump presidency, which sent the markets up quite a bit if you remember the July run, right? I know my accounts hit all-time highs, some pretty crazy trading days. And now with Kamala in, the markets are uncertain. You have the whole issue going down in Japan. No one knows who the president's going to be because they're locked in a dead heat right now, according to the polls. Markets are uncertain. And you might ask yourself, why in the world am I listening to this? I'm a beginner investor. I want to know how to start. The reason why I bring this up is you are most likely going to have an opportunity of a lifetime to buy stocks at what they were worth 2 to 3 years ago during COVID or prior to 2019 COVID, because we're probably only halfway through these stocks going down. I think whoever wins the presidency in the US, I think that's really going to in part determine the foreign markets. And I also think what Jerome Powell does with the Federal Reserve rate will also affect the US stock market significantly in the next 3 to 6 months and really determine what type of recession we're really looking at here. If we're going to bounce back, I think there's a lot of upward pressure on the market, but I think things are finally hitting the wall with the interest rates. There's a lot of commercial loans that are coming due. There's just a lot of uncertainty in the market. Make sure you're in a position where you can invest as much money as possible, because I think you're going to have a phenomenal opportunity to buy into a market bottom here in the next 3 to 6 months. And I think we have another 10 to 15% to go, because overall the whole market isn't down. We just saw like the big six lose a bunch of value over the last week. I think the rest of the market has a ways to go before the bottom. So how to start investing? What should you do? Number one rule to investing is if you actually want to make a lot of money and you follow this one rule, it's going to benefit you tremendously in the long run, and that's don't time the market. There's this principle called dollar cost averaging where you just buy into the market consistently. And over time, the average price that you pay is going to be lower than you trying to time the market to sell when it's high and buy when it's low. 90% of retail investors, actually of investors overall, lose money when they're engaging in these day trading tactics over a 10-year period. So again, if you just schedule it to come out of your paycheck once a month, you are going to be phenomenally better off than if you're trying to time the market when the market goes up, when the market goes down, when the market goes in circles. The other thing that you want to do, if you want to guarantee yourself average returns, is you just want to buy index funds. I recommend index funds over mutual funds or ETFs because there is this little thing called an expense ratio, and it's how much you pay whoever manages that fund to put the stocks in and out of it that they choose. Usually with an index fund, you're going to be paying an expense ratio around 0.03%. Or if you'd invested $100,000, you're going to pay $300 a year to have it managed. Versus if you have a really expensive ETF where it's like a 3% management fee, you would be paying $3,000 a year off of $100,000 invested. And that's really expensive. When you're thinking of expense ratios, let's say the average market return is 10% per year on average, which if it's S&P 500 over the last 30 years, I think it's close to about 12.5% right now. But if you look at it historically, S&P 500 usually returns around 8%. At the end of the day, what you really want to look at is how much are you paying to have these funds, quote, managed when you're buying an index fund. Or if you hire a CPA to manage your stocks they're going to cost you a point and a half. People say point, it just means a percentage. When you're listening to the Fed talk about lowering interest rates by 25 basis points or 50 basis points, that's actually 0.25 or 0.5%. So theoretically, if like mortgage rates were at 6.5% right now, and in September, if the Fed lowers the Federal Reserve rate 50 basis points or 0.5%. Theoretically, mortgage rates would reflect that roughly and come down to roughly 6%. Again, what the Fed rate is and what mortgage rates are different. There is a delta there between what the Fed rate is and what your mortgage rate is. It's because the bank is in between and they get the money from the Fed to then loan to you. They're a merchant of money. And they make a lot of it because of that. So when people are talking about points, just be aware of that. And be aware of how much you're paying your CFP, your certified financial planner, because if they're charging you 1.5%, you're getting a 10% return. That actually takes your return down to 8.5%. And then if they're buying like ETFs or mutual funds on top of that are averaging about a 1% or 0.5% return, it takes you down to 7.5 average annual returns. You minus inflation, realistically, your money is only growing, once you take that extra 3% off, your money is only growing by like 4.5%. So you have to be aware of how you're investing your money and where your costs come from. Just like running a business, just like being financially literate, you have to be literate when it comes to investing. And a lot of times there's just these really industry jargon terms that seem really complex, but they're not if you actually take the time to go ahead and learn them. Now, when you're investing, again, I recommend index funds because you can get like an index fund in the S&P 500. That's like the 500 largest companies in the United States by market cap. And you get, theoretically the best of the world. They'll manage the funds. So when a company drops out, it'll reinvest into the next company that comes in. For example, in this, I think it was actually last year, not this year, but Lululemon entered the S&P 500. So you get all the upside of being invested in Lululemon without having to directly buy the stock, but you also get, you're invested in companies like Caterpillar, John Deere, Tesla, Nvidia, right? These massive companies that typically have really good returns and really well-established markets. When you're also looking at investing, and typically all of these stocks that I just talked about, they're considered large cap stocks. And it kind of has to do on market cap and their revenue, on what they consider large cap, medium cap, and small cap stocks. You have to be careful. You can get really good returns on small cap and medium cap stocks because there's a lot more room for them to grow and take up market share and, gain emerging markets as well. But there's also a lot more risk in that company being able to continue being solvent, have good lines of credit, and survive economic events such as recessions. So at the end of the day, when you buy an index fund or a mutual fund or an ETF, you get the advantage of being able to buy into multiple stocks and diversify your risk. The negative thing is when you diversify, and especially when you over diversify, you get average returns. And your objective when investing is to beat the S&P 500. If you beat the S&P 500, you're doing a really good job. And again, like I said, that's 12%. And most managers can't do that over a 10-year period. You're best off just to invest in the S&P and leave your money there. Now, some people think they're really smart and think they can beat it, and you have to decide if you're that person. What Warren Buffett does to beat it is he looks at companies where he has a really fundamental understanding of their business model, of their market, and he decides, if he also likes their management, he decides if he wants to invest in that business. Now, the interesting thing about Buffett is sometimes he likes management, but oftentimes he looks at the business model more. And he said this before in, so many words, but if I put a donkey as CEO of this company, would this company continue to make money? Because managers and management will change over time. And another reason why I bring up managers can do a really, really good job on growing a company. If you look at Good to Great by Jim Collins, his book, he details how management does have a really big impact on companies that are able to, outperform market returns by double digits. At the end of the day, what Buffett does is he buys individual stocks. Typically speaking, he invests in individual companies that he believes have really good business models, really good essentially moats around them that protect their business from leaving. And if you look at Warren Buffett's fund, Berkshire Hathaway, if you date it all the way back to when he started it, they have averaged an internal rate of return, or how much, their fund has returned, of, I believe it's 34-ish% over the last 40, 50, 60 years. I can't remember exactly when he started it. I do believe it was back in the early 60s. That's why he's one of the richest people in the world, is because when you compound at a rate of 30% per year, you're doubling your money every 2.1-ish years, which is just complete insanity. You do that over 50 years, you're going to have a really big stack of cash. In fact, one of the things about Berkshire Hathaway's issue is they have so much money to deploy that it's really hard to continue with those outsized returns because of how much money they're actually trying to invest. Whole nother issue for a different video. And that's one objective. The big risk is when you buy like individual stocks, you're kind of like SOL. you have a greater risk if it goes to zero. You can also be over-invested in a certain industry. You might be over-invested in tech stocks or manufacturing or agriculture. There's a lot of different areas where you can become over-indexed in. And if that particular section of the market goes sour, for example, the dot-com bubble in 2000, you could stand to lose the vast majority of your money. So you want to walk the line between being over-diversified and being under-diversified in this ideal scenario where you're diversified enough that you're protected from potential downsides while allowing your upside to be greater than, like the S&P, 500 return of 12%. At the end of the day, you have to decide how much risk you're willing to take on, what you're willing to do, and make a plan to do that. Now, as far as actual steps go for investing, if you're going to do it yourself, I recommend finding a brokerage account. If not, I recommend finding a really good CFP that you trust, that you're willing to pay for. Once you do that, you come up with your plan, how much risk you want to take on. A good way you can measure this is via what they call SDEV, or the standard deviation of your portfolio. And you can back test your portfolio over a certain period of time. If you hire a CFP, they should be able to do this for you and give you the numbers. If they don't, I'd highly question them. Let me put it that way, because they're either A, just being lazy, or B, they're probably incompetent. And what that does is it shows you how much the stock goes up and down during an average year over however many years you want to back test for. And for example, if your standard deviation is 10%, that means a stock, if it was $100, during a given year will go between $90 and $110. And sometimes you have stocks with a standard deviation of 20% or more. Sometimes it's 30%. It's like, if you invested $100, are you okay with it going from $100 all the way down to, 70, and then up to 130, and then down to 75, and then up to 110, and then back down to 70? If you are good with that, if you're okay with that risk tolerance, sure, invest the money. If you're not, you need to look for stocks where you can get a standard deviation that's as close as you can get to zero, right? Depending on how intolerant of risk you are. And if you really don't like that, you can invest in other things such as bonds. You can keep a certain amount of cash on the sideline. You can do high yield interest accounts that right now they can give you as much as 4.5%, 5%, depending on where you invest. Marcus is a retail side of Goldman Sachs Bank for personal banking. They have a really high interest rate right now. Apple Card has a savings account that they added on that has a really high interest rate. And historically, Capital One also has a really good high yields savings bank account. If you want to check who has like the highest yield or highest APY on savings accounts, NerdWallet's a really good place to reference that. They make and write articles on it all the time, usually a couple of times a year, updating it. You can also invest in things like real estate and businesses. Now, a really interesting thing, and one of the things that you should really consider is, where is your knowledge of expertise? Because if you're, like, for example, really knowledgeable about forest products and logging and industry, maybe you should go invest in forest land, because you know what type of margin per acre you're going to have when you buy it. You're really knowledgeable in that, but you don't know anything about stocks, for example, or that about farmland, or you're really good at analyzing franchises or single family investment properties, or maybe you're really good at multifamily, right? There's a million different things you're really good at that you might have a really high knowledge about. So you might want to proportionally put a large percentage of your net worth, of the money you're investing, into those types of investments, because you understand them. You know what's going to be a good return, and you know what isn't going to do well. And the last piece of advice I can really give you that's highly valuable is invest where your knowledge base is. Invest in your own domain, where you are the expert, where you are the industry leader, because that's going to give you outsized returns. And if you're a business owner, 9 times out of 10, the best return you're going to get is in your own business. The average new business startup that actually makes it, the IRR, or internal rate of return, over the first 5 years is 30%. Remember, S&P 500, 12.5. Do you want 12.5% or 30% rate of return? You're probably going to get more money out by investing it in your own business, or more money back. Now, the trick is always taking profits or taking chips out of the game and putting them away for your rainy future in case you do lose it all when you're investing in yourself, which is always a possibility, and you need to account for that potential downside. That being said, I hope this video was helpful. I know it was a little random. It's Investing 101. It was kind of a large overview of my general knowledge, but if you got any value of it whatsoever, please subscribe to the channel. Helps me find more entrepreneurs just like you who want to grow their businesses and invest the profits. Hope you have a great day, and see you next time.